Hey savvy investors! Ever wondered how to find stable income and incredible growth opportunities in real estate, especially in a dynamic market like Singapore? Today, we're diving deep into the world of Singapore real estate investment trusts to uncover 3 top performers that are hitting all the right notes, especially with their incredible occupancy rates. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. What exactly are the S-REITs? Think of them as companies that own and manage income-generating real estate. Singapore's REIT market stands as a significant pillar within the nation's listed stock landscape, characterized by its substantial international exposure, with over 80% of assets held abroad. This global diversification helps. In fact, the IEG S-REITs index delivered a total return of 17.4% in Q3 2024, outperforming both the Straits Times Index and major US equity indices. But why are we focusing on occupancy rates between 90% and 95%? Simple. High occupancy isn't just a number. It signals strong demand for REITs properties and directly translates to stable income generation. It demonstrates incredible resilience, especially for Singapore-listed office S-REITs, which broadly performed well in Q1 2025, even amidst broader macroeconomic uncertainties, thanks to consistent high occupancy and sustained demand. For investors, it means these REITs are operationally efficient and well-positioned for strategic growth. Based on our dual criterion methodology, which prioritized high occupancy and market capitalization for prominent entities, we've identified 3 stellar S-REITs that maintained this robust occupancy profile in Q1 2025. They are CapitaLand Ascendas REIT, Frasers Logistics and Commercial Trust, and ESR Logos REIT. These aren't just any REITs, they are prominent and liquid entities in the market. Let's dive into each one. Starting with CapitaLand Ascendas REIT, Singapore's largest listed business space and industrial REIT. As of March 31, 2025, CLAR reported an overall portfolio occupancy of 91.5%. This slight decrease from Q4 2024 was primarily due to a substantial decline at the Telepark data center in Singapore, but this was partially mitigated by high occupancy rates at other Singapore properties. CLAR manages a massive 16.8 billion Singapore dollars diversified portfolio across 225 investment properties. What's truly impressive are its strong positive rental reversions in Q1 2025. Australia led with a remarkable 59%, followed by the US at 10.3% and Singapore at 7%. Management anticipates mid-single-digit rental reversions for the full fiscal year. CLAR's growth is fueled by both organic improvements and aggressive inorganic strategies. The strong rental reversions and a stable weighted average lease expiry of 3.8 years indicate resilient underlying demand. In Q1 2025 alone, CLAR completed a 153.4 million Singapore dollar acquisition of the DHL Indianapolis Logistics Center in the US, which was 100% occupied upon acquisition. They also completed the 300.2 million Singapore dollar redevelopment of 1A, and 1B Science Park Drive in Singapore, already 95% leased. This demonstrates CLAR's proactive strategy to optimize its portfolio by divesting or redeveloping underperforming assets and acquiring high-quality, future-ready properties. Their expansion into data centers and life sciences strategically positions them to capitalize on demand in these new economy sectors. Financially, CLAR is robust. Its aggregate leverage remained healthy at 38.9% as of March 31, 2025, providing ample capacity for strategic investments. A significant 73.6% of its debt was on fixed rates, providing strong insulation against potential interest rate fluctuations. Plus, an A3 credit rating from Moody's facilitates access to competitive funding. This strong financial capacity for aggressive growth sets the stage for future distribution per unit, or DPU, growth. Analysts are bullish on CLAR, generally assigning buy or strong buy ratings. The average 12-month price target suggests a significant upside potential of 20 to 23% from current trading prices. Next, let's look at Frasers Logistics and Commercial Trust. This REIT reported an impressive overall portfolio occupancy of 93.9% as of March 31, 2025. A key highlight for FLCT is its logistics and industrial portfolio, which boasts an exceptionally high occupancy rate of 99.6%. This segment is clearly the primary engine driving FLCT's overall growth and stability. In Q1 2025, the L&I segment demonstrated strong positive rental reversions, achieving plus 8.7% on an incoming versus outgoing rent basis, and an impressive plus 33.0% for new and renewal leases signed between January and March 2025. Management anticipates continued robust figures, attributing this to existing leases being 20 to 30% below current market rates. FLCT's growth strategy combines organic improvements with strategic inorganic expansion. They're actively recycling capital from divestments, like the Cross Street Exchange, to acquire higher-yielding assets, including their inaugural logistics facility acquisition in Singapore. Development and asset enhancement initiatives are also crucial, with ongoing projects in the Netherlands and recently completed ones in the UK. A significant advantage. FLCT has access to the largest right of first refusal pipeline from its sponsor, valued at over 5.0 billion Singapore dollars. This extensive pipeline could potentially double FLCT's portfolio size, providing unparalleled visibility for future acquisitions and long-term growth. FLCT maintains a robust and prudent capital management approach. Its aggregate leverage remains stable and low at 36.1% as of March 31, 2025, offering substantial debt headroom of 447 million Singapore dollars before reaching the 40% gearing threshold. Its interest coverage ratio is a healthy 4.5x. And here's a unique aspect. 72% of its total borrowings are green or sustainability-linked financing, aligning with broader ESG objectives. Analysts give FLCT buy or add recommendations, with an average 12-month price target suggesting an upside potential ranging from 27% to a whopping 50%. Last but not least, ESR-LOGOS REIT, strategically positioned as a new economy-focused real asset owner and manager. ELOG reported a healthy overall portfolio occupancy rate of 91.6% in Q1 2025. ELOG's portfolio is primarily focused on logistics real estate, data centers, and infrastructure. Their commitment to the new economy sector is evident, with these assets accounting for 70.3% of its effective gross revenue in Q1 2025. ELOG recorded positive rental reversions of plus 8.6% in Q1 2025, primarily driven by its logistics and general industrial segments. This focused approach aligns the REIT with long-term structural trends in e-commerce and digitalization. ELOG's growth strategy is propelled by a combination of strong organic performance and its 4R strategy, rejuvenating the asset portfolio, recapitalizing for growth, recycling capital, and reinforcing sponsor commitment. Recent accretive acquisitions, such as the ESR Yatomi Kisasaki Distribution Center in Japan, contributed significantly to higher net property income. Asset enhancement initiatives are actively underway to maximize unutilized plot ratios and enhance tenant experience. The REIT also benefits from strong sponsor support, leveraging ESR Japan's expertise and backstopping preferential offerings. ELOG has made notable progress in optimizing its financial health. Its gearing improved to 41.9% in Q1 2025 from 42.8%, reflecting disciplined capital management. The weighted average cost of debt also saw a positive trend, falling to 3.65%. A significant 81.7% of ELOG's borrowings are on fixed rates, providing strong protection against interest rate volatility. They also actively recycle capital, evidenced by divestments of non-core assets above their book value. ELOG typically receives buy ratings from the analyst community, with an average price target of 0.338 Singapore dollars. While these REITs shine, Analysts consistently highlight key themes and concerns impacting the broader S-REIT sector. The higher for longer interest rate environment is a significant headwind, leading to increased finance costs. However, our selected REITs demonstrate prudent capital management and high hedging ratios to mitigate these impacts, transforming a sector-wide challenge into a distinguishing factor. Macroeconomic uncertainties, geopolitical tensions, and FX volatility for international portfolios are also concerns. But here's the good news. The ongoing flight to quality trend benefits newer, prime office developments in Singapore, enabling them to navigate market uncertainties more effectively. Furthermore, the limited new office supply anticipated in Singapore's core central business district from 2025 to 2027 is expected to support rental stability and modest growth in this segment. This means well-managed REITs with quality assets are strategically better situated. So, what does this in-depth analysis mean for you, the investor? Income stability. These REITs offer attractive dividend yields, CLAR at 5.92%, FLCT at 5.48%, and ELOG at 9.38% TTM, supported by stable occupancy and positive rental reversions. Capital appreciation. Analysts project significant upside potential, ranging from 20% to 50%, driven by expected operational improvements, accretive acquisitions, and potential re-rating of their valuations. Risk assessment. While promising, investors should be mindful of interest rate risk, global economic slowdowns, currency fluctuations, and specific property tenant risks. Investment considerations. These REITs offer a compelling investment case for both income-focused and growth-oriented investors. Investing across a selection of these REITs could offer diversification benefits across different property types and geographical exposures. Remember, each REIT offers unique exposure. CLAR is diversified but leans into technology and life sciences, FLCT excels in logistics, and ELOG maintains a clear new economy focus. This means you can choose the REIT that best aligns with your specific investment objectives. The quality and strategic acumen of the REIT manager are crucial for long-term success, especially in navigating challenging environments. In conclusion, Capitaland Ascendas REIT, Frasers Logistics and Commercial Trust, and ESR Logos REIT distinguish themselves as leading Singapore REITs with robust occupancy rates, strategic portfolio management, and sound financial health. They are well positioned to deliver both stable income and potential capital appreciation. Always do your own detailed due diligence on their assets and management teams. If you found this insightful, hit that like button, share with your friends, and subscribe for more deep dives. Thanks for watching, and happy investing.